Welcome back. Well, the markets are as flat as can be as we speak. The Nifty, it moved into the red. Now, in fact, it's moved back into the green. It's up close around 35 points odd. But the Nifty Bank, that's unmoved, and that could be the joker in the back. But let's focus on a couple of other names. Affle India, that's the next corporate we're tracking. After the board approved raising some funds. Well, to understand more about that, Mr. Anuj Khanna Soham, the founder and chairman of the company, joins us. Hi, Anuj. Well, run us through these plans, in terms of what are you all doing? And I believe you're looking at some inorganic growth as well. So run us through those plans.
Sure. Well, thank you for having me on your show, and congratulations, first of all, to all the Argentinian fans. I think the momentum towards 2023 should be quite positive. Now, Affle is a very strong believer in the long-term thesis of our strategy. And when the markets are showing signs of certain areas of weakness in the macroeconomic sense, we are actually finding some very attractive value-based transactions that can actually help us to accelerate our inorganic growth strategies going into 2023 as well as long term. So what we are looking for is those targets and those companies that are already profitable, versus in the past we have done acquisitions of companies that were losing money or breaking even, and then we would turn it around through using our tech and strategies. Now we are looking for companies that are already profitable but still are being valued on the same basis as companies that in the past were just barely breaking even. So we are getting good value-based transactions where we can look for not only strategic growth, but also margin expansion on a sustainable basis and drive deeper verticalization with our customers as well as in the industry. So we are taking this kind of an approval from our board where we can use not only the cash that we have, but also selectively, very carefully use our equity through a swap mechanism, which is allowed by SEBI on a 90 days weighted average of our share price for certain transactions or certain part of those transactions. And since those negotiations are already quite actively on, looking into early 2023, we wanted our board to give us the support to exercise, using equity swap as a mechanism if it is appropriate for any transaction for inorganic growth.
So what you are saying is that your board has given an approval of a share swap of about 35 lakh shares, right? At a price which is based on a formula of the last 90 days.
So the regulation, I mean, we have never used this before, and we are all kind of going through the regulatory requirements. So SEBI has a floor price requirement for any share swap transaction, which is based on the 90 days weighted average. And today, the 90 days weighted average is actually 10% higher than, or approximately 10+% higher than the current trading price of the company. So, and this will keep moving on depending upon when we close the deal, when we go to the shareholders for approval. But, we will use it very carefully, this currency of using equity for share swap. We will use it very carefully and conservatively to drive value for our shareholders. Two, we will only use it selectively to align those entrepreneurs who are coming on board for long-term retention with longer-term lock-in periods, not just the typical 6 months lock-in that one would give in the equity swap, but we are looking at more like using it as a tool to align the entrepreneurs for even 2 years or possibly longer. Yeah.
But Anuj, you must have a size of acquisition in mind, right? Because you've given a cap on the number of shares you're willing to swap at 35 lakh, which gives us an approximate range of how much money the company can raise, which could be 350 crores, it could be 400 crores, depending on when you go ahead and take that approval, right? So broadly, that's the amount of funds you would need to raise. So I'm saying that if you look backwards, that you probably have an acquisition target in mind because you know how much you need to raise.
So first of all, it is not a fundraise. There will be no funds being raised. It is a share swap. So let's say we're looking at a company where the founder of the company still owns, say, 50% of the share of their company. Instead of giving the cash into the hands of the founder, we could give some cash and some equity swap and make sure that the founder is retained and logged in with us for at least several years to come. And therefore, there is no fundraise in the process. It's the approval roughly is about $50 million US worth of equity, which I think in INR terms translates to around 400+ crores. But we're not looking at a fundraise. We're using it as a tool as a currency to pay and swap the shares of the founder of that company who was previously owning his company shares. Now we are saying, sell your company to us, join our company, and give the alignment, the strategic alignment to that entrepreneur to stay invested for next many years to come using some of our equity instead of holding their own share, and then consolidate that company into us for inorganic purposes.
Anuj, but using shares as currency, but a currency which is depreciated 50% from its highs, right?
So first of all, the 90-day average is actually 10% higher or 15% higher than where it is today.
Okay.
So that's one. Secondly, we're not using it right away. We've just got the approval. And depending upon where the stock market is and the prices, we will use that currency very selectively and only use it for the purpose of incentivizing the entrepreneur who's going to be full-time working with us for next many years. So it actually works out as a good negotiation tool in the process to align the entrepreneurs for the long term. Like even in the past, like when we acquired all our acquisitions, we have done 100% cash acquisitions, and then we do use our stock option plan to build retention plans for the entrepreneur. So effect is the same. Now this time around, if we are saying that if we find the right opportunity and if we can align it with some portion of the transaction and equity swap, it actually makes perfect sense.
Companies, are you doing due diligence right now?
Well, let's put it this way, that every transaction that Affle has already done in the past, our courtship period with those companies was at least 3 years. So given that context, we are already talking to a very strong pipeline of these companies. Now, the ones that we're talking to this time around are from day one going to expand our margins as well, right? This is a big difference. Every company we acquired in the past were actually just breaking even. This time around, the companies that we're looking for 2023, they will already help because they're already profitable and they will bring margin expansion. Having said that, we would still value them on the same kind of multiples that we valued the previous transactions. Because the markets are a bit down, we think that we are getting the right kind of valuation to not only find strategic growth, but sustainable market expansion and verticalization to grow inorganically.
Anu, just to put it very simply, as of last quarter, you're doing around 19.5 to 20% of margins. So the acquired company, if at all, whenever you close it out, those margins will be better than what you're doing currently. Is that correct?
Well, two things there. First, we will acquire only those companies that are already meaningfully profitable, which means the EBITDA has to be in the 15 to 20% range. That's one. Secondly, we obviously with our tech and strategies and efficiencies in the business model would further expand that. So the idea of doing this transaction is not only to find strategic growth, but do sustainable margin expansion within the first year of the company's acquisition itself. So once they're combined with us, and as we execute with them, we would expect margin expansion in year one versus, in the case of Jam or the other transactions where we were waiting till year 3. That is the difference in 2023's M&A strategy for us.
And the target is that the company should have margins of 15 to 20%, and from there on, you all will take it, right?
Absolutely. Absolutely.
All right. We'll leave it there. Thank you very much for your time. Good luck. And we hope to speak with you once you are closer or once you close one of these transactions. Thanks indeed for joining us with all of that detail. Okay, let's welcome in next management of Arvind Fashions. We have Kulin Lalbhai now joining in. He's Executive Director at Arvind Fashions. Kulin, great to have you with us here on CNBC-TV18. Good morning, Prashant this side. Could you give us a real sense of, sales in this quarter so far, how things panned out? I mean, there was the Black Friday sale as well. Are overall sales back above pre-COVID levels? Just some qualitative picture, Kulin.
Sure. This has been a very strong year overall on demand. And I think the theme of this year has been, the re-energizing and resurgence of the offline side of the business. If you visit any mall of the country today over a weekend, I think you will see the sheer number of people that are out there to shop. So I think in general, the mood of the market and the underlying growth drivers are very, very strong. In the first half of the year, we've grown at, upwards of 40%. And even the Diwali, last year, in fact, Diwali was a very strong quarter because it was the quarter where people just had gotten back out after the COVID waves. So the base itself was strong. And even on that strong base, we continue to see growth. So I think the growth momentum continues to be strong.
Any big strategic shifts plans for 2023? Can you outline your top 3 initiatives for the next year?
Sure, we've charted out a very clear strategy for ourselves for the next 3 years. We are now focused on building very, very large mega brands. The idea is, we have these 5 to 6 very, very strong brands which are leaders in their segments. And we would want each of them to become 1,000 crore plus brand in this next 3 year period. So one of them is already very, very large. US Polo, we shared with the market in the first half itself, till the month of October, it has crossed revenues of 1,000 crores, and it will emerge as the leading largest casual wear brand in the country. And similarly, we have a lot of 500 crore brands, and we will try and scale them up to that 1,000 crore mark, because that's when there is a huge pivot on the profitability and return on capital employed side. So we are going to scale up significantly, and the couple of drivers of growth, we are going to be opening stores. India is opening up with small town India now really consuming branded apparel very differently. So we are opening upwards of 200 stores every year across these brands. We are dominant in the digital channel. We expect that channel to continue to remain extremely vibrant. So we will grow with digital and build our capabilities there. And we're also scaling up very exciting adjacent categories within these brands. So we're becoming very well established in footwear, innerwear, kidswear. These are all opportunities for these brands to become truly lifestyle brands. And with scale, we expect much improved profitability and return on capital employed moving forward.
Hi, Kulin. Always good hearing your thoughts. You're sounding quite, optimistic about demand on ground. So that's pretty good news. You briefly mentioned profitability right now. So give us a sense on that. What's the targeted margins out there? You're in the high single digits. Do you think you can maintain it at around double digits? And if things are looking so good, you end this year with revenues of close to around 4,000 crores?
Yes, on the profitability side, the guidance we've given is that for our power brand portfolio, we do expect overall pre-Ind AS double-digit profitability within 12 months. And hopefully at a company level also, in 18 months' time, we will be double-digit pre-Ind AS profitable. So as we scale up these brands and the operating leverage kicks in, you will see this enhanced profitability. We've been also every quarter showing how the profitability is going up, and we expect that trend to continue. On the scale and the revenue equation, I think the kind of revenues you spoke about are what we should be able to achieve this year.
How many large brands do you think you said how US Polo is the first 1,000 crore brand that you have? How many more such can achieve that milestone in 2023? And do you have any brands which are currently unprofitable or are not meeting your strategic requirements and you may look to offload them?
So, US Polo is a lot larger than 1,000 crores, but the rest of our brands are around that 500 plus or minus crore mark. So they will take a couple of years to get to the 1,000 crore mark, but they are well on their way. As far as our portfolio is concerned, we do not have unprofitable brands now. We exited the businesses which we believed were unprofitable and unstrategic over the last 2-3 years. So everything we have today is break-even plus, with the large brands obviously having higher profitability in general. And as we scale the other mid-sized ones to much larger scale, we will see them also converge to higher profitability.
All right, Kulin, what's the ideal revenue mix between online and offline? Obviously during COVID period, that ratio got stretched in favor of online. But as of now, I mean, going ahead, how do you see things shape up?
So we have kind of post-COVID changed the base of online. So, online used to be a 15 to 16% of revenue sort of channel pre-COVID. Of course, during COVID, it became a very dominant channel. But now that, the offline channel has fully recovered and it's, in fact, now, as I mentioned, very vibrant, the online share has now stabilized to around 25%. Now, if you take a longer term period over the next 5 to 10 years, the online channel will grow faster than the offline channel, because that's structurally how it is in every part of the world. So one could expect this 25% to gradually move up in the years to come.
Okay, got it. All right. And also, you briefly mentioned you're also moving into new revenue streams like footwear. Could you tell us what's the target out there? Say by 2025, what kind of revenues could come in from this segment?
So, this year our footwear business will be close to 250 crores. It's been a very interesting business for us because, like apparel, there is a dramatic change happening on the footwear side where the country is casualizing. I think you may have seen how many people wear sneakers even to office nowadays. And since we have such dominant casual wear brands, it gives us the opportunity to actually try and play a more dominant role as far as the casual sneaker part of footwear is concerned. And that's where US Polo is emerging as a very strong brand on the digital and offline side. And because the business is still relatively smaller, we've built this business up over the last 5 years, it should grow much faster than the core business. So, there is an opportunity to, double the business in the next 3 years or so.
What's the growth rate of the online channel versus the offline channel? You said that online channel is growing a lot faster. It's about 25% of your revenues. What's the growth rate that we've seen recently?
If you look at the last 10 years, the growth rates have been very high. Even the last 3 years, it's been more than a 25% CAGR. Now, of course, the base has become much larger. Online is now one of the dominant channels. So I do still believe that structurally, around a 20% growth over the next 3-4 years should be possible in the online channel.
Okay, all right, Kulin, always good hearing your thoughts. Thanks so much for joining in all of 2022, and we look forward to chatting up with you in 2023, unless you make an announcement in the next few days. Wishing you a good, Christmas as well as festival season. Well, on that note, though, we'll slip into a short break. When you come back, Nitish Thakkar will be back with us.
Picked up a bit for our markets. We're up about 65 points in the Nifty. Commodity names are moving up. It is one of the big bets that Ajay Srivastava was making, that commodities will do well despite all the cyclicality that we are likely to see. He was betting on commodities, Tata Steel, Hindalco, JSW Steel. These are stocks which have seen buying come through in the last 30 minutes. Apart from that, the big gainers include Bharti Airtel. That's the top Nifty mover, up close to about 2%. The street is going to be watching. Are we going to see any price hike from Bharti Airtel in the first quarter of FY23? In Jan to March of calendar year 23? That's something the street will be watching. And ITC, it's been a big star, a big wealth creator this year, up 55%. And it looks like it's ending this year with a flourish, currently up 1.5%. But let's get in a few technical calls as well. Mitesh Thakkar of earningswave.com is back with us. Mitesh, still very quiet on the markets, 18,336 on the Nifty. Any trade and stocks that you would recommend?
Yeah. So as I said, I think, around 18,400, 420 levels we'll explore buying into put options on the index. But that apart, on stock side, I have one buy and one sell, and you highlighted ITC, which has come on the buy list. I think a good rebound after a consolidation for many weeks. ITC, I think, is a conditional buy once it starts getting past 341, 342. Buy with a stop at 337 for a target of 355. While on the sell side is Indian Hotel. After a long time, this stock is giving signs of correction. So sell here with a stop at 325, targets of 310 to about 308 on the downside.
Okay, all right. Thanks a lot for that, Mitesh. By the way, the HDFC twins, they are the ones that are taking your breath away. Just pull up the intraday chart of HDFC twins. Maybe we could get a split screen. Both of them have recovered a goodish bit from the low point of the day, and a couple of these large cap names are doing well. So the HDFC twins, you have Infosys that's cut its losses as well, and it explains why, as we speak, we're at the high point of the day. You got the intraday dip, and that, in fact, has got bought into. For the time being, though, let's turn our attention to the commodity space. Manisha Gupta is standing by to run us through all the cues coming in from there. Morning, Manisha.
Keeping the flag high, really, Nigel, when it comes to commodities there. And within the energy space, we're looking at the coal prices absolutely outperforming the whole sector there. If you look at the prices itself, we are 21% up for the month of December and 140% up for 2022. Very strong gains is what we've seen in this year. We didn't start the year like that, though. In the month of Jan, it was nearly $157 per ton that we started with the coal prices. You've seen an all-time high in the month of September. And right now, the prices are not trading too far away from those kind of levels, still holding above $400 $400 per ton there in the international markets. A few reasons on why you have seen gains come in for the prices. One, Europe has seen shortage of gas for power generation. That has kept the coal prices on the higher side for most part of this year. And then it also has been about stronger demand coming in from India. Also take a look at the mining stuff from Australia, where you have all the big names looking at lower production. So whether it was Glencore, BHP, Anglo American, you saw floods hit mining in many of these major miners, and that kept the prices higher. Also, when you look at the IEA report, that basically summarizes on how the year 2022 has been. So they say that the global coal demand has hit a record high in this current year. They also believe that the demand is expected to go forward, see a bit of a decline. 2025, by then, you will see demand continue to decline, and the prices also are expected to come off those kind of highs. But the next couple of years, the demand and prices are expected to be on the firmer note there. It also says that China, India, Indonesia have hit record production in this current year. And even with that, the kind of demand that we've seen is kept the prices higher. Russia is the third largest coal exporter, and we have seen those numbers continue to decline. Last year was 174 million tons, this year 160, and next year is expected to decline further as well. But that is not the case with Indonesia, which exports thermal coal. Last year was 432, this year 438, and it is expected to see a surge of 450 million tons in the next year as well. So Indonesia, as an exporter of thermal coal, will continue to surge from there. Price forecast for next year is quite important on your screens. We are trading at $400 a ton right now. So it's expected to average at around 280 is what Fitch thinks. Bank of America puts the number to 300, ANZ at 361. And the most bullish of forecasts at an all-time high expectation comes from Trading Economics. They expect the coal prices to trade at $485 per ton at some point in time in 2023.
Okay, all right. Thanks a lot for that, Manisha. Well, let's review a couple of stocks then that are on focus at around 10 a.m. Going across to Ekta first, she's joining us to tell us about Sun Pharma. Ekta?
Thanks for that. Well, yes, definitely negative news, a sentiment negative actually come in for Sun Pharma, where they have told the exchanges that they have received that warning letter from the US drug regulator. Now, remember that this is largely known simply because on the 8th of December, it was known that they were issued an import alert for their Halol facility, and the warning letter would be a part of it. But it just seems as though there is a bit of a sentiment reaction for investors when it comes to Sun Pharma, reminding them of what the issues might be for Halol going forward. I just want to put it into perspective in terms of the Halol plant. It has been under the scanner for a couple of years now. For example, it was issued a warning letter in 2015. It was cleared in 2018, re-inspected in 2019 of December, issued 8 observations at that point in time, had an official action indicated status all the way since March 2020, and they hadn't been able to resolve that. They were issued 10 observations and an inspection which took place earlier this year, and now that turned into an import alert. There are a couple of products which are excluded from this, and hence the financial impact could probably be less for Sun Pharma. But nonetheless, negative news. It's a reminder for investors that yes, Halol will probably take some time to resolve.
Ekta, thank you very much for that. Let's get to Surbhi, and she's going to tell us about UTI AMC. Surbhi?
Hi, thanks for that. So UTI AMC has been surging in trade today, and that is because the report suggests that Tata Group is in final talks to buy a majority stake in UTI AMC from 4 state-owned financial entities. PNB, LIC, SBI and Bank of Baroda together own close to 45% stake in the company. The reports also suggest that the final agreement is being sought on deal valuation and internal approvals have been secured. Tata has also received in-principle nod from T. Rowe Price Group, which owns close to 23% stake in the company. If this deal goes through, the combined firm will be the 4th largest AMC in India. These reports have not been independently verified by CNBC-TV18.